In a move that has sent ripples through the global energy market, China has halted imports of liquefied natural gas from the United States. This decision, driven by a newly imposed 15% tariff on U.S. LNG, marks a significant escalation in the ongoing trade war between the two economic giants. For American LNG exporters, the immediate impact is a staggering $1.5 billion loss in revenue. This sudden shift in energy trade dynamics has left the U.S. scrambling for alternative markets, while other players, particularly Australia, are seizing the opportunity to expand their presence in the lucrative Chinese market. The decision to impose tariffs on U.S. LNG is seen as a direct retaliation to earlier U.S. tariffs on Chinese goods. This tit-for-tat exchange of tariffs has characterized the U.S.-China trade relationship for the past few years, creating uncertainty and volatility in the global market. The LNG tariff is just the latest salvo in this ongoing trade war, and its impact is being felt far beyond the energy sector. The halt in U.S. LNG imports to China is the longest pause in trade since June 2023, highlighting the seriousness of the current situation. This disruption comes at a time when the global demand for LNG is on the rise, driven by factors such as economic growth in emerging markets and a global shift towards cleaner energy sources. As the world seeks to reduce its reliance on coal, natural gas, particularly in its liquefied form, has emerged as a cleaner alternative for power generation and industrial use. The roots of the current LNG standoff can be traced back to the escalating trade war between the United States and China. This trade war, initiated during the Trump administration, has been marked by a series of tariffs and counter-tariffs imposed by both sides on each other's goods. The initial U.S. tariffs were aimed at reducing the trade deficit with China and protecting American industries from what the U.S. government perceived as unfair trade practices. China, in turn, responded with its own set of tariffs, targeting key American exports like soybeans and automobiles. These retaliatory tariffs were designed to inflict economic pain on American businesses and pressure the U.S. government to reconsider its stance on trade. The back-and-forth exchange of tariffs has created an atmosphere of uncertainty and instability in the global trading system, with businesses and investors struggling to adapt to the constantly shifting landscape. The decision to specifically target U.S. LNG with a 15% tariff is seen as a strategic move by China. By imposing a tariff on this crucial energy source, China is signaling its willingness to use its economic leverage to achieve its geopolitical objectives. The timing of the tariff, coming at a time when global energy prices are already volatile, is also significant. The immediate casualty of China's decision to halt U.S. LNG imports is the American energy sector. With a $1.5 billion dent in their expected revenue, U.S. LNG exporters are now facing a significant challenge in finding alternative markets for their product. The U.S. has been aggressively expanding its LNG export capacity in recent years, capitalizing on the shale gas boom and positioning itself as a major player in the global LNG market. However, the Chinese market, with its rapidly growing energy needs, was seen as the crown jewel for American LNG ambitions. This sudden disruption in trade flows has exposed the vulnerability of relying too heavily on a single market, particularly one as politically charged as China. While the U.S. explores alternative markets for its LNG, such as Europe and India, these markets are already crowded with competitors and may not fully compensate for the loss of the Chinese market. On the other side of the Pacific, Australia is reaping the benefits of China's decision. With a nearly 25% surge in its LNG exports to China, Australia is now positioned as a dominant player in the Chinese energy market. This development underscores the shifting dynamics in global energy trade, with traditional alliances and partnerships being tested by economic and geopolitical considerations. Australia's success in the Chinese market can be attributed to several factors, including its geographical proximity, its reputation as a reliable supplier, and its willingness to engage in long-term contracts that provide price stability. The 15-year LNG supply deal between China Resources Gas International and Australia's Woodside Energy Group, starting in 2027, is a prime example of this strategic partnership. Section 4. Energy as a Weapon, Geopolitical Implications of China's Move. Beyond the immediate economic impact, the halt in U.S. LNG imports to China carries profound geopolitical implications. It highlights the growing rivalry between the two superpowers and the increasing use of energy trade as a strategic weapon. For China, reducing its dependence on U.S. LNG is part of a broader strategy to diversify its energy sources and reduce its vulnerability to external pressures. This strategy involves securing long-term energy deals with other suppliers, such as Russia and countries in the Middle East, as well as boosting domestic energy production. By reducing its reliance on the U.S., China aims to enhance its energy security and strengthen its hand in geopolitical negotiations. For the United States, the loss of the Chinese market represents a setback in its efforts to maintain its global economic and geopolitical dominance. The U.S. has long sought to use its economic might to advance its foreign policy goals, and energy exports have played a key role in this strategy. The current situation underscores the limitations of this approach and the challenges of using trade as a leverage in an increasingly multipolar world. Section 5. Navigating the New Energy Landscape, Future Trajectories. The current standoff between the U.S. and China over LNG trade highlights the complex and evolving nature of the global energy landscape. As the world transitions towards a cleaner energy future, the competition for energy resources is intensifying and traditional alliances are being tested. The outcome of this competition will have far-reaching consequences for the global economy, geopolitics, and the environment. For the United States, the challenge is to find alternative markets for its growing LNG exports and to adapt to a world where its economic dominance is no longer absolute. This will require a pragmatic approach that balances economic interests with geopolitical realities. Australia, on the other hand, is well positioned to capitalize on the growing demand for LNG in Asia and beyond. Its abundant natural gas reserves, established infrastructure, and strategic partnerships give it a significant advantage in the global LNG market. However, Australia must also navigate the geopolitical complexities of the region, particularly the delicate balance between its economic interests and its alliance with the United States. The future of the LNG market, and indeed the global energy landscape, remains uncertain. What is clear, however, is that the days of unchallenged U.S. dominance are over, and a new era of energy competition is upon us. Welcome to Global Insight Network, your trusted source for in-depth global commerce and economic insights. In today's video, we're diving into a major shift that's shaking the world's energy markets. China has just halted U.S. LNG imports, resulting in a $1.5 billion loss for the U.S., and giving Australia the chance to dominate the market. But why is this happening? And what does it mean for the future of energy trade? Stick with us as we explore how this decision could reshape the global energy landscape in ways you may not expect. As we navigate the new energy landscape, it's crucial to understand the broader implications of this shift. The halt in U.S. LNG imports by China is not just a trade issue, it's a signal of changing power dynamics in the global energy sector. For the United States, this move underscores the need to diversify its energy partnerships and explore new markets. The challenge will be to maintain its competitive edge while adapting to a multipolar world where energy resources are increasingly contested. Australia, on the other hand, stands at a crossroads. With its abundant natural gas reserves and strategic geographic location, it has the potential to become a leading LNG supplier in the Asia-Pacific region. However, this opportunity comes with its own set of challenges. Australia must carefully balance its economic aspirations with its geopolitical alliances, particularly its relationship with the United States. The future of the global LNG market is uncertain, but one thing is clear: the days of unchallenged U.S. dominance are over. As we move towards a cleaner energy future, the competition for resources will only intensify. This new era of energy competition will have profound implications for the global economy, geopolitics, and the environment. Stay tuned to Global Insight Network for more updates and in-depth analysis on this evolving story. Thank you for watching, and don't forget to like, comment, and subscribe for more insightful content. To understand the full impact of China halting LNG imports, we must first look at the broader U.S.-China trade war. Over the past few years, the U.S. and China have been in an intense economic standoff, imposing tariffs and counter-tariffs. But this recent move is a game-changer for global energy markets. Historically, China has been a major importer of U.S. LNG, a crucial export in the energy sector. However, following President Trump's aggressive trade stance and China's response, things have drastically changed. In February 2025, China announced a 15% tariff on all U.S. LNG imports, immediately disrupting the flow of natural gas. But the repercussions of this decision extend far beyond the immediate financial losses for the U.S. energy sector. For one, the European Union, heavily reliant on imported energy, could find itself caught in the crossfire. As the U.S. seeks new markets for its LNG, Europe could become a battleground for energy dominance. This could lead to increased competition and potentially lower prices for European consumers, but it also risks entangling the EU in a broader geopolitical struggle. Meanwhile, emerging economies in Asia and Africa, which are rapidly increasing their energy consumption, might find themselves with new opportunities and challenges. These countries could benefit from more competitive pricing as suppliers vie for their business, but they also risk becoming pawns in a larger geopolitical game. Finally, this shift could accelerate the global transition to renewable energy. As traditional energy alliances fracture and the competition for LNG heats up, countries may double down on investments in wind, solar, and other renewable sources to ensure energy security and reduce dependency on volatile international markets. The halt of U.S. LNG imports by China is more than just a trade dispute. It's a catalyst for a potential reshaping of the global economic and energy landscape. As we continue to monitor this evolving situation, one thing is clear: the ripple effects will be felt worldwide. Thank you for watching Global Insight Network. Make sure to like, comment, and subscribe for more in-depth analysis on the global economy and energy sector. Stay tuned for our next video, where we'll delve into the potential winners and losers in this new era of energy competition. This decision is more than just a political maneuver, it's an economic earthquake. For the U.S., LNG exports to China had become a critical revenue stream. In 2024 alone, the U.S. exported over $10 billion worth of LNG to China, making it the largest consumer of American natural gas. But now, with China turning its back on U.S. imports, the $1.5 billion loss could escalate if the situation persists. The U.S. energy sector, particularly those in energy-dependent regions like the Gulf Coast, now face the brunt of these financial repercussions. What does this mean for U.S. businesses relying on this trade, and what measures could be taken to recover lost market share? Firstly, the immediate impact will be felt by companies and workers in the LNG industry. Job losses, reduced revenue, and halted projects could become the new norm. For small and medium-sized businesses in the Gulf Coast region, this could spell disaster, potentially leading to economic downturns in local communities. Secondly, U.S. energy companies will need to pivot quickly to find alternative markets. Europe, with its increasing energy demands, could offer a lifeline, but this will not be without its challenges. Competing with other LNG suppliers such as Russia and Qatar means that U.S. companies will need to offer competitive pricing and establish strong trade relationships quickly. Lastly, this crisis could be a catalyst for innovation within the U.S. energy sector. Companies might accelerate their investments in renewable energy sources, aiming to diversify their portfolios and reduce dependency on volatile international markets. Government support and incentives could play a crucial role here, helping businesses transition smoothly while maintaining economic stability. In conclusion, China's cold shoulder to U.S. LNG imports is more than a trade dispute, it's an economic earthquake with far-reaching consequences. As the U.S. navigates this turbulent landscape, the resilience and adaptability of its energy sector will be put to the test. Stay tuned to Global Insight Network as we continue to explore the evolving global energy dynamics and their implications for economies worldwide. Thank you for watching. Don't forget to like, comment, and subscribe for more in-depth analysis and insights. See you in the next video. Why did China decide to halt U.S. LNG imports in the first place? The answer is complex. Beyond the tariff retaliation, China is also looking to diversify its energy sources. The geopolitical landscape is rapidly shifting, and China is positioning itself to reduce reliance on U.S. exports. This decision aligns with China's long-term strategy to secure energy sources from more reliable, geographically closer partners. The ongoing trade war only intensified this sentiment. But how exactly does this strategic shift benefit China, and what are the risks involved? Firstly, by diversifying its energy imports, China aims to enhance its energy security. Relying heavily on a single country, especially one with which it has strained relations, poses significant risks. By forging stronger ties with countries like Russia, Qatar, and Australia, China can ensure a steadier supply of LNG, reducing the risk of future disruptions. Secondly, this move allows China to negotiate better terms with its suppliers. With multiple options on the table, China can leverage its massive demand to secure more favorable prices and conditions, potentially saving billions in the long run. However, this strategy is not without its risks. Diversifying suppliers means navigating complex geopolitical landscapes. For instance, while Russia is a key ally, its own geopolitical tensions and economic instability could pose challenges. Additionally, relying on multiple suppliers can lead to logistical complexities and higher transportation costs. Moreover, this shift could strain China's relationships with other major trading partners. The U.S. in particular might view this as an escalation in the trade war, potentially leading to further economic and diplomatic repercussions. In conclusion, while China's decision to halt U.S. LNG imports is a calculated move to enhance its energy security and economic leverage, it comes with its own set of challenges and risks. As the global energy landscape continues to evolve, China's ability to navigate these complexities will be crucial. Stay tuned to Global Insight Network as we continue to explore the evolving global energy dynamics and their implications for economies worldwide. Thank you for watching. Don't forget to like, comment, and subscribe for more in-depth analysis and insights. See you in the next video. Enter Australia, a major beneficiary of China's decision. As the U.S. falters, Australia is stepping up as a critical supplier of LNG to China. In 2025 alone, Australia's LNG exports to China surged by 25%, positioning Australia as a dominant player in the Chinese energy market. Australia's LNG industry has become one of the world's largest, and with China now needing to replace U.S. imports, Australia's energy sector is experiencing a major boost. In fact, Australia now supplies 35% of China's LNG imports, a massive increase in market share. This shift could have profound implications for global energy trade and further solidifies Australia's role in the Asia-Pacific energy market. The increased demand from China has spurred investment in Australian LNG infrastructure, creating jobs and fostering economic growth. However, this growing dependency also poses questions about Australia's ability to meet future demands and the environmental impact of ramping up LNG production. Stay tuned to Global Insight Network as we continue to explore the evolving global energy dynamics and their implications for economies worldwide. Thank you for watching. Don't forget to like, comment, and subscribe for more in-depth analysis and insights. See you in the next video. Australia's rise as a global energy supplier is no accident. Over the past decade, Australia has invested heavily in developing its LNG export infrastructure. With this new opportunity to fill the gap left by U.S. LNG exports, Australia is not only securing a profitable deal, but also positioning itself as a key player in Asia-Pacific energy diplomacy. As China's energy demands continue to rise, Australia is in a prime position to continue its dominance. However, this market share shift could have unintended consequences for Australia's relationship with other global powers, like the US and Europe. While Australia solidifies its ties with China, it may find itself in a delicate balancing act, ensuring that its alliances with Western nations remain strong. The geopolitical landscape is complex, and Australia's strategic decisions could influence not only its own future, but also the broader dynamics of international relations. In conclusion, Australia's ascendancy in the LNG market is both an opportunity and a challenge. As it navigates this new terrain, the nation must carefully consider its long-term strategies and the potential ripple effects on its global standing. Stay tuned to Global Insight Network as we continue to explore the evolving global energy dynamics and their implications for economies worldwide. Thank you for watching. Don't forget to like, comment, and subscribe for more in-depth analysis and insights. See you in the next video. The shift in global energy trade is about more than just economics, it's about power. The global energy market is one of the most significant geopolitical tools of the 21st century. With China now relying on Australia for its energy needs, this decision could alter global energy diplomacy for years to come. The U.S., once a dominant force in energy exports, must now reassess its global strategy. The consequences of China's move could trigger a broader realignment of energy supply chains. But the real question remains, how will other countries, particularly those in Europe and India, respond to these shifts in trade patterns? As the world watches, the strategic repositioning of energy alliances may redefine international relations. Europe, grappling with its energy security concerns, might seek diversified sources to avoid over-reliance on any single supplier. Meanwhile, India, with its burgeoning energy demands, could emerge as a pivotal player, seeking new partnerships and trade routes to secure its energy future. The energy chessboard is complex, and every move by a major player affects the global landscape. As nations navigate this intricate game, the stakes couldn't be higher. Energy is not just a commodity, it is a cornerstone of national security and economic stability. Stay tuned to Global Insight Network as we continue to explore the evolving global energy dynamics and their implications for economies worldwide. Thank you for watching. Don't forget to like, comment, and subscribe for more in-depth analysis and insights. See you in the next video. As we look ahead, the future of US, China, and Australian energy trade seems uncertain. The US faces the challenge of recovering lost market share in China while seeking alternative markets. Meanwhile, Australia is positioned to expand its role as a dominant energy supplier in the Asia-Pacific region. The next few years will be critical in determining how these energy shifts affect global energy markets. Will the US regain its footing, or will Australia continue to solidify its dominance in this sector? The answers to these questions will not only shape the economic landscapes of these nations, but also influence global geopolitical dynamics. As energy remains a cornerstone of national security and economic stability, the stakes have never been higher. Thank you for joining us on this journey through the complexities of global energy trade. Stay tuned to Global Insight Network for more in-depth analysis and insights into the ever-evolving world of energy. Don't forget to like, comment, and subscribe to stay updated with our latest content. See you in the next video. In conclusion, China's decision to halt US LNG imports is more than just a financial setback for the US. It's a major geopolitical move that could have lasting implications for global energy markets. Australia is emerging as a dominant force in energy trade, but the US is not giving up just yet. What do you think will happen next? Will Australia maintain its dominance, or will the US find new ways to recover and compete? Let us know in the comments below. We want to hear your thoughts. If you found this analysis insightful, make sure to like, subscribe, and hit the notification bell to stay updated on the latest global economic trends. Thanks for watching, and we'll see you in the next video.